Datavault AI Inc., trading under the ticker symbol DVLT on the Nasdaq, is currently seeing its live stock price sitting at 50 cents per share during the intraday trading session on Monday, June 1, 2026. This represents a modest intraday upward movement of 0.60% from its previous baseline, though the stock has been fluctuating tightly between 48 cents and 55 cents throughout the day. While a $0.50 stock price usually suggests a microcap company struggling for survival in the shadows of giants like Tesla stock or Apple stock, what just happened behind the scenes changes the narrative entirely. The company just executed a non-binding term sheet for a staggering $2 billion structured financing transaction with an institutional investment fund and a United Kingdom-based regulated investment platform. This is a massive financial arrangement for a business with a market capitalization sitting around $425 million, and it has sent shockwaves through retail trading channels from specialized investment sites to individual brokerage accounts. The structure of this arrangement is not a standard cash placement but an asset-backed setup where Datavault AI will issue common shares at an implied value between $1.55 and $2 per share in exchange for preferred units in an investment vehicle holding fixed income securities. This specific pricing structure represents an incredible premium over the current 50-cent trading level, shaking up the traditional calculations retail traders use when comparing microcap tech plays against established giants like Nvidia stock. For an asset that has been beaten down roughly 88% from its 52-week high of $4.10, this massive structured financing announcement introduces an extreme divergence between how the market currently prices the asset and what institutional parties are potentially willing to value it at. The general market expectation for microcap companies trading in the penny stock range is that they are constantly on the verge of dilutive death spirals, forcing investors to seek professional investment help or flee to conservative options like Schwab Intelligent Portfolios. The typical retail trader expects these businesses to survive on small, highly dilutive equity lines that slowly chip away at shareholder value. The reality here presents a massive contrast, as this proposed $2 billion transaction is structured across 4 successive tranches of up to $500 million each, with the first tranche targeted for completion by the third quarter of this year. Investors using standard online investing methods are scrambling to analyze the fine print because this deal comes with major strings attached, including the requirement that the counterparty route all of its global digital asset tokenization and blockchain projects exclusively through Datavault AI's patented platform. If you look closely at the trading volume and daily swings happening on major platforms like Robinhood and Interactive Brokers, you can see a sudden shift in how market participants are positioning themselves. For months, short sellers and risk-averse investors viewed this company as a highly speculative, cash-burning venture, often managing their risk by shifting capital into diversified instruments like Fidelity ETFs, Fidelity mutual funds, or algorithmic alternatives like a SoFi robo-advisor. The collective belief was that without an immediate cash injection, the operational runway was dangerously short. However, this contrarian development forces a complete rethink of that thesis. If the definitive agreements are signed, the counterparty will gain the right to nominate board directors with each tranche closing, which could ultimately hand them majority board control by the time the final tranche wraps up. This means the reality of Datavault AI's corporate governance could look entirely different in 12 to 18 months, turning it into a captive infrastructure provider for a multi-billion-dollar global investment network. This is the kind of underlying institutional shift that rarely shows up on standard retail screens or basic online investment apps until long after the smart money has made its move. Let us look deeper into the immediate structural pressures and short-term capital requirements that this announcement brings to light, because this is where the operational tension intensifies. To even get this massive deal off the ground, Datavault AI faces an immediate binding obligation to fund $25 million in administrative and structuring costs for the very first tranche. That initial $25 million non-refundable payment is due by June 4, 2026, which is just a few days away. According to corporate statements, the company plans to source these funds through a combination of Bitcoin holdings and the sale of existing receivables. This creates an immediate catalyst and a tight operational deadline that is driving significant volatility and heavy volume across major retail venues like the Robinhood app and the Interactive Brokers platform. Traders who engage in self-investing are keeping a close watch on whether the company can successfully clear this immediate cash hurdle without causing near-term disruption to its balance sheet. This creates an intense near-term trading environment where daily volume spikes by colliding with complex macroeconomic pressures. When you examine how retail volume flows through platforms like SoFi Active Investing or a Fidelity brokerage account, you notice that microcap stocks announcing multi-billion-dollar numbers usually experience wild speculative retail rallies, yet the price action today remains relatively anchored at 50 cents, showing that the market is treating this non-binding term sheet with a heavy dose of skepticism. Retail investors have become incredibly sophisticated, using advanced tools on the Fidelity trading platform or Interactive Brokers trading tools to dissect corporate filings. They know that a non-binding term sheet is not a closed deal, and it still faces massive hurdles, including deep due diligence, shareholder votes, regulatory clearances, antitrust reviews, and a highly critical review by the Committee on Foreign Investment in the United States. Furthermore, the company will have to amend its corporate charter just to increase the number of authorized shares needed to fulfill such a massive issuance. This creates a prolonged period of uncertainty where expectation and reality will constantly battle for control over the stock price. Comment below how many shares of Datavault AI you currently hold, or if you are weighing on the sidelines for definitive agreements to be signed.
To fully understand why the company is taking such an aggressive structural pivot, it helps to examine what Datavault AI actually does and how its business model has shifted over time. Headquartered in Beaverton, Oregon, and originally incorporated back in 2010, many long-term investors tracking tech sectors on popular investing sites might remember this entity under its former identity, WISA Technologies Inc. For years, the company operated primarily within the semiconductor and wireless audio space, developing technologies designed for high-definition, multi-channel wireless sound transmission under brands like WISA E and Audio. They built an intellectual property portfolio centered around audio timing and precise synchronization. However, recognizing the slow growth and intense margin pressure inside the legacy hardware and semiconductor sectors, the organization executed an asset purchase from privately held Datavault Holdings at the end of 2024. This acquisition completely altered their trajectory, leading to an official corporate name change to Datavault AI Inc. in February 2025. Through this shift, the company merged its legacy acoustic sciences with a brand new data sciences division focused on cloud-based platforms for data management, digital engagement, credential validation, and real-world asset tokenization. Instead of just selling wireless audio components, the business model now revolves around helping large organizations identify, value, and monetize their existing enterprise data assets using proprietary software agents known as DataScore and DataValue. They even integrated IBM's Watson X platform to provide data valuation and governance compliance. Their technology stack includes platforms like VerifyU, which delivers tokenized, blockchain-backed academic and institutional credentials to prevent fraud. More recently, just days before this massive financing announcement, the company signed a mutual services agreement with Perpetuals.com to list its real-world asset tokenization programs on a regulated European multilateral trading facility. This pipeline includes commodity-based initiatives like Gold Vault, Coppercoin, and various geothermal energy infrastructure programs, with confirmed targeted token issuances already exceeding $328 million. Looking back at older financial reports clarifies why the company is aggressively pursuing these massive institutional partnerships. Financial data visible across Fidelity wealth management platforms and standard stock research sites shows a history of significant operational stress. In the quarterly reports leading up to early 2026, the company showed massive fluctuations in its members. For instance, while they reported a massive spike in revenue to $33.8 million in December 2025 due to asset integrations, their standard operational quarters like March 2026 saw revenues drop back down to $3.4 million against total operating expenses exceeding $31 million. Research and development expenses have consistently climbed, hitting $5.7 million in the early part of 2026, while selling, general, and administrative costs swelled to over $25 million. The structural imbalance resulted in a negative EPS of minus 96 cents, explaining why the stock has experienced such severe downward pressure over the past year. When operational costs vastly outpace core revenue, a company must either scale its business model instantly or rely heavily on external capital. This financial reality is exactly why the legacy perception of the company has been so bearish, and why risk managers using institutional setups or conservative retail channels like Fidelity IRAs or the Fidelity mobile app typically avoid such volatile assets. When a company is burning cash to build out a Web 3.0 data exchange infrastructure, it runs into a classic chicken and egg problem. It needs massive scale to attract institutional data assets, but it needs massive capital to build the secure, compliant infrastructure that institutions demand. The recent agreement to list commodity tokenization programs on regulated venues in Cyprus represents an operational attempt to bridge this gap by proving their commercial viability. If they can successfully tokenize physical commodities like copper and gold, they establish a concrete track record that could validate their broader data valuation software. As we look toward the future outlook for Datavault AI, the trajectory of the stock will depend entirely on how the tension between market expectations and operational reality resolves. In a best-case scenario, the company successfully delivers the initial $25 million payment by June 4th, executes definitive agreements for the first $500 million tranche by the third quarter of 2026, and begins absorbing a massive global pipeline of exclusive tokenization projects from its new institutional partners. If this reality materializes, the current 50-cent stock price will look like an absurd valuation anomaly, and the market will likely reprice the asset closer to the implied institutional acquisition value of $1.55 to $2 per share. This outcome will reward aggressive self-directed investors who utilize sophisticated trading tools on platforms like the SoFi trading platform or Interactive Brokers' fees-optimized accounts to take calculated risks on distressed microcaps. Conversely, the risk factors here are exceptionally high and cannot be ignored by anyone engaging in online investing. If the company fails to secure the initial $25 million for administrative costs, or if the due diligence process uncovers regulatory roadblocks during the intensive governance review process, the entire $2 billion deal could fall apart. If that negative reality hits, the market's darkest expectations will likely be confirmed, potentially triggering a severe liquidity crunch and forcing the company to return to highly dilutive, small-scale equity lines just to keep the lights on. This would cause further downside, driving the stock toward its previous lows and leaving retail traders on basic stock trading apps holding significant losses. The contrast between these two distinct paths creates an environment of maximum uncertainty. To summarize the core insights, Datavault AI finds itself at a historic crossroads, where its legacy identity as a struggling wireless audio and semiconductor business has been completely overwritten by an incredibly ambitious pivot into blockchain-backed data monetization and real-world asset tokenization. The current live intraday price of 50 cents reflects a market that remains deeply skeptical of penny stock promises, pricing the company based on its past operational losses and high burn rate. Yet the reality of a tentative $2 billion institutional financing commitment at a massive premium challenges every single bearish assumption built into the current valuation. Whether this company becomes a dominant structural layer for global digital assets or serves as a cautionary tale about the gap between non-binding corporate announcements and actual execution will be determined in the coming days and months. Investors across all platforms, from premium automated services like Schwab and intelligent portfolios to active self-directed accounts on Robinhood, SoFi Invest, and Fidelity must weigh this immediate operational deadline against the long-term structural opportunity before making their next move. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.